You know how sometimes you see a market just turn on a dime? One minute, things look fine, and the next, a major asset just takes a complete nosedive. Well, that is exactly what happened with precious metals on the morning of April 20th. But the real story here, it wasn't happening on the trading floors. It was playing out at sea, with warships and a whole lot of global tension. So let's unpack what went down. Right. This was the number that shocked traders. -2%. In just a couple of hours, the price of silver on the MCX exchange crashed by a full 2%. And gold wasn't too far behind. I mean, this wasn't some gentle slide. It was a sudden, sharp sell-off that had everyone asking the exact same thing. It feels a little backward, doesn't it? I mean, usually geopolitical conflict sends investors running for cover to so-called safe haven assets, like gold. But not this time. So let's unravel exactly how an incident in the Gulf of Oman sent this bizarre ripple effect across the entire global market. Okay, so let's set the scene. It's Monday, April 20th, 2026. Markets open, and for precious metals, it's just a sea of red. And we're not talking about a minor dip here. This was a really significant, widespread plunge. And the scale of this drop was pretty serious. On India's MCX, gold fell over 1%. But silver? Silver got hit even harder, crushing by 2%. That's a drop of over 4,500 rupees. And it wasn't just local. International spot prices did the same thing, with both metals down about 1%. This was a synchronized global sell-off, and the trigger wasn't something you'd find in an economic report. To really get the why behind this, we've got to look away from the trading screens and turn our attention to one of the most critical maritime choke points in the entire world, the Strait of Hormuz. Because this is where our story really kicks off. All of a sudden, news breaks of a major escalation. The U.S. Navy had reportedly fired on and then seized an Iranian-flagged cargo vessel. The reason they gave? That the ship had just ignored repeated warnings to stop as it was leaving the strait. And that single act of aggression, it set off an immediate, and I mean immediate, chain reaction. Now here's where it gets really interesting. Tehran's response. They didn't just protest. They immediately started targeting other ships and reasserting their control over the Strait of Hormuz. Their whole argument was that the U.S. action was basically a blockade, and that it violated a ceasefire agreement that was already in place. And just like that, the entire region was on high alert. So the big question is, how on earth could one single incident in a tiny body of water cause such a massive shockwave? Well, let's trace the ripple effect, step by step. Okay, the first and most immediate impact was on oil, of course, right? You've got a major conflict brewing in the world's most important oil transit lane. So the price of crude just shot up. Brent crude jumped 6% to over $95 a barrel, and US WTI crude was up 7%. The market was suddenly pricing in a massive energy supply shock. So here's how it all connects. It's like a series of dominoes falling. First, you have the conflict in the strait. That causes domino number 2. Oil prices spike. Now, what happens when energy costs go through the roof? Well, domino number 3, fears of inflation come roaring back. And what do central banks do when they fear inflation? They start thinking about hiking interest rates, domino 4. And that leads us to the final and most surprising domino, gold and silver prices fall. And this right here is the heart of the paradox. For decades, the rule of thumb was simple. Fear of inflation was good for gold. But this is a new kind of fear. Today, it seems like the market is way more terrified of what central banks will do to fight that inflation. We're talking about hiking interest rates. You see, higher rates make holding on to gold, which pays you 0 interest, a lot less attractive. And on this particular day, that fear of rate hikes just completely overpowered gold's traditional job as an inflation hedge. So, okay, where do things go from here? With all this volatility, it's a good idea to see what market analysts are saying to get a feel for the sentiment and the key price levels everyone's watching. According to Plunge, who's the CEO of Enrich Money, the overall feeling out there is just caution, a lot of caution. He's pointing out that there's a real risk here, that if gold can't punch through its upper price ceilings, those resistance levels, the momentum could just fizzle out and prices could actually fall even further. And here are the actual numbers that analysts are watching on the MCX. Think of these as the lines in the sand. For gold, the key floor, or support level, is around $1,052,500. If it breaks below that, we could see a bigger slide. The ceiling, or resistance, is up at $1,055,000. And for silver, that floor is at 248,000 with a ceiling at 255,000. These are the battlegrounds for traders right now. So what's the big picture here? What can we really learn from this one single dramatic day in the markets? Let's connect all the dots and pull out the main takeaways. First off, this is a pretty stark reminder that geopolitical events can just slam energy prices in an instant. Second, that shockwave in oil prices quickly turns into global fears about inflation. But the most crucial lesson, the real game changer here, is the third point. The fear of central banks and their rate hikes can now be a more powerful force for gold than the fear of inflation itself. And that exposes a whole new vulnerability for an asset that many people thought was the ultimate safe bet. And that leaves us with one last, kind of tough question. In a world that is this interconnected, where a naval standoff in one little strait can instantly crush the value of a precious metal thousands of miles away, what does a safe haven even mean anymore? It really makes you wonder, doesn't it?